Good evening. Good evening, Zoom participants. I see y'all saying hi. Hi, Blanca. Hi, Latasha. I see so many familiar faces tonight. I see you, Alex. I see you, Eric. I remember y'all's faces in person, so we're so excited to have you guys join us here tonight. Miss Contessa, we see you. Thank you so much for being here. Y'all, tonight we are talking about one of the most important subjects that there is to talk about when it comes to financial fitness, when it comes to getting ready for home ownership. And that subject is credit. If you don't know me, if you don't know who I am, you must not have been tuning into our webinars, y'all. Go back and watch our webinars on demand. My name is Blaine Cower. I am the Senior Director of Homeowner Services for Dallas Area Habitat for Humanity. And I have the great pleasure and privilege of working on our homeowner services team at Dallas Habitat. That means I get the chance to work with every client that comes through our program, and especially I get the chance every day to work with our fabulous homeownership counselors who are here tonight. Porfirio Coronado and Aretha Higgins. They are our two wonderful counselors. Here they are. Hey, Aretha. Aretha, you're on mute. You too, Porfirio.
Hey.
How are y'all doing?
Yeah, thank you. Good evening, everyone.
Good to see you guys. I know I see you on video every day, but I still miss seeing your faces in person. So happy to have you guys here tonight. To everybody who's here, I need y'all to know that these are our experts. Porfirio and Aretha are both homeownership counselors for Dallas Area Habitat. Individually, they work with hundreds of first-time buyers through our program every single year. And combined, they have over 15 years experience doing what they're doing. So let you guys introduce yourself. Aretha, do you want to kick us off?
Sure. Hi, everybody. I appreciate you all coming to learn about, more, just get more education, put it like that. And it's a pleasure to be here this evening. I am the senior homeownership counselor in Dallas Habitat. And as many of you might know from viewing the community, I've celebrated 10 years recently with Dallas Habitat. So I've been doing this for a while, and I truly enjoy it. It's such a pleasure to be able to help as much as I can and be able to assist you all in your journey to home ownership. And just look forward to working with all my clients. I know as many of you on here right now, we haven't spoken yet. You've gotten an email from me, but we haven't personally spoken to each other over the phone, but that's coming, okay? So again, I'm just excited about you all coming and getting all the information. Thank you.
Thank you, Aretha. Porfirio, welcome.
Hey, well, thank you so much for having me today. Good evening, everyone. As y'all know, my name is Porfirio Coronado, and I've been with Dallas Area Habitat for 5 years now. So I started off at an entry-level position. Now I'm a counselor. So recently I was certified with HUD Certified Counselor Agency. So I am glad that I was able to tackle down that, and glad to work with a lot of y'all. See a lot of familiar names like Miss Constance Smith, Eric. So I'm glad to see her here. I see Isamar Campos. So together, Rita and I have had 15 years together. I have 5 and Rita has 10, working with Dallas Area Habitat.
Yes, Aretha just celebrated her 10-year anniversary last month. Give it up for Aretha. Woo-hoo. Yeah. Okay, so like I said, today we are here to talk about credit. Here's the thing, guys. The truth is, we know this at Dallas Habitat in the work that we do. Almost everybody that asks me about how the Dallas Habitat program works and homeownership counseling starts it off by saying, well, I just need to let you know, I don't have great credit. My credit's okay, I need to work on it needs to get better. Here's the thing, credit is incredibly important to the homeownership process, but if you have the tools and the resources and the information that you need to improve your credit, get your score where it needs to be, get your debt under control, it's incredibly manageable. And your counselor will help you do that if you're working through our homeownership program. Porfirio and Aretha will look at your credit report with you and help you strategize around that. So tonight, we're here to talk a little high level about credit, the things that you need to know, especially in the context of buying a home if you're a first-time home buyer. And we're gonna answer your questions as always. So before we get started, a couple of housekeeping rules. As always, we are recording tonight's webinar. That allows us to be able to archive this webinar on our website and also on our YouTube channel so that you or friends, family, anybody that you know is able to go back and watch it on demand after the fact. So just know that. You can also access this information through the homebuyer community if you've applied for our program, and that's another option. If you're new to us on Zoom tonight, know that we want to hear from you. We like interaction at Habitat. So we're going to run a couple of polls tonight to be able to get some feedback from you guys. And at the very end, we're going to save some time to do a moderated question and answer session. If you see the Q&A box in your Zoom app, make sure that you drop questions in there. We will answer some live during the presentation. Others will hold to answer on air at the very end. With that being said, Porfirio, I'll turn it over to you.
All right, thank you so much, Blaine. Give me 1 second. Let me go ahead and share my screen with y'all. Are we good with that?
Yes, you can see that.
Awesome. So today, like we said, we're going to be talking about making sense of credit and how your credit score of the is like your GPA of adulthood. So everyone, all of y'all know, like whenever y'all in school, y'all were always like graded on the GPA. So today, the GPA of adulthood is going to be credit. So we're going to go ahead and get started with that. Okay, so the agenda we're going to be talking today, one of the first things is going to be understanding your credit score. So, so what exactly your credit score is. And then we're going to talk about the credit reporting agencies. So what are the 3 major credit reporting agencies there are? And then what are the factors that determine your credit scores? And also establishing your credit ways to improve it. Okay, so first of all, what we're going to do, we're going to go ahead and run a quick poll, and Arit's going to help us do this.
All right, so we want to hear from you right out the bat. So we're going to do our first poll. Okay, so the question is, while shopping at Target, you're offered a 15% discount if you apply for their credit card. You like discounts, so you do it. How does this impact your score? Okay, you got some answers there to choose from, and we want to hear from everybody. What do you think?
We want to hear from y'all. Make sure you drop your answers in there. Here comes a few answers. Love it.
And don't worry if you don't get the answer right. This is all learning. We're having fun here, okay?
It's also anonymous. So don't worry if you're not sure. No one will know it was you. And this poll, as y'all will notice, this is actually a 4-question poll. So you can vote on all 4 of those questions in this poll.
Yes, you can go ahead and do all 4 right now if you want to, if you see it. I see someone asking. The second one says, out of nowhere, COVID-19 hits and you find yourself financially stressed. You miss 2 monthly payments on your student loans. How does this impact your score? The third one, you pay down your credit cards to less than 30% of your total credit limits. How does this impact your score? Your best friend, number 4, your last one, your best friend asks you to co-sign for their car note. Then they fall 2 months behind on their payments. How does it impact your score?
Okay, it looks like just about everybody has voted. I'm going to end this poll and share the results. All right, can y'all see those?
Yes, we can see it, Lorraine.
Hey.
Okay.
All right, Aretha, how did we do?
Well, the majority of people on the first one, let's see. The majority of people said 8 points. Congratulations, that's correct. Okay, number 2, the majority of people, it looks like you said minus 20 points. Guess what? It's minus 50. Poll question number 3, the majority of people said 20 points. The correct answer is 40 points. And the last one, number 4, the majority of people said a whopping 30 points. It's a whopping 60 points. So good job, everybody. Okay, again, this is a learning process. And we just want you to, in doing this poll, we just wanted to kind of show how your behaviors affect your credit score, okay?
Yes, Ms. Walker says, wow, 60 points. Here's the thing, we know none of our participants on today's webinar are co-signing for their BFF, right?
I hope not.
Well, we'll talk about it by the end of the presentation. If you're thinking about it, you'll auto reconsider. Okay, very good.
So one thing that I wanted to point out on this real quick is that as you see that whenever something negatively hits your credit score, it impacts it the most. And whenever something positive hits it, it impacts it the less. So it's kind of like, again, we talked about earlier at the beginning, we said that the credit scores like your GPA, remember whenever you used to get a C on your math class and that brought your GPA down? So it's exactly the same thing with your credit score. Once you get a bad grade on a credit card or a bad credit, then it drops it dramatically. Now, if you get something good like an A, or you do like a good credit, then it tends to take a lot more time to increase that credit. All right, let's go ahead and move on.
Okay, so we're gonna go ahead and present today, and the first topic is what is a credit score, okay? And your credit score is it's a numerical snapshot really to help lenders predict whether you will repay a loan or credit card debt. The higher the score, the less risky you appear to a financial institution. The lower the score, the higher risk you look to a lender, okay? So it's just a 3-digit number that predicts how likely you are to pay back money you borrow. Okay, and we have some different scoring models. Some of the different scoring models, you have FICO, which is one of the main ones that's out there that people are familiar with. You also have the Vantage score. You have some people that use this, but the one that most people are familiar with is the FICO. And this is the one that's traditionally used by most lenders. Okay, this is the one that they're going to use, the FICO score. But I want to talk about some credit score ranges and what they mean to a lender, okay? So say for instance, you have the credit score range is 740 to 850. That is considered excellent credit. Borrowers get easy credit approvals and you have some of the best interest rates, okay? But when you have, now we're going down to 670 to 740. Okay, that's good credit. Borrowers are typically approved and you're typically offered good interest rates. 620 to 670, that's acceptable credit. Borrowers are typically at higher interest rates with these numbers, 620 to 670. Okay. 580 to 620. Now we're getting into what we call subprime credit. It's possible for you all, for any borrowers to get a mortgage, but not guaranteed. Terms will probably be unfavorable at this range, 580 to 620. Now we have 300 to 580. This is considered poor credit. There's little to no chance of getting a mortgage, and borrowers will have to take steps to improve the credit score before being approved. So you see those big differences, 740 to 850, 670 to 740, different ranges. But I want y'all to know what that means. So when you get in front of a lender and they're telling you what your credit score, but before you get out of counseling, you're gonna have a good score. Let me just say that. We're gonna work on getting you a credit score, a good credit score. That's what we do for you all. That's what we help do. We guide you to make sure you have a good credit score. So when you get in front of a lender, you're gonna get offered those great interest rates, okay? And the better loan products. Porfirio, you have anything to add to that?
Right. One thing that I wanted to add is that the Vantage credit score system is typically what they use for the Credit Karma. So if all of y'all are using like Credit Karma to track your credit history right now, that's a good way to track it. It's not the best way to track the credit score. That's usually inflated by 30 to 50 points from the actual FICO score. And that's basically because they receive third-party information from different agencies that report to them. So, which is why it's not the best way to track your credit score. It is a good way to actually just track your credit history to see if anything you hit your credit score. Okay, so if you're looking at your FICO score on Credit Karma, then make sure that you deduct 30 to 50 points from it, and that will actually give you a better snapshot of your actual FICO score.
Next slide. All right, who generates the scores? Okay, you have three main credit reporting agencies: Experian, TransUnion, and Equifax. But what a lender, always, any mortgage lender, they're gonna use a tri-merge credit report. That means they're pulling from all three credit bureaus, okay? And what they're gonna do, they're gonna toss that high score, toss the low score, and the middle score is what they're gonna use. They don't take an average of your scores, okay? That's just how they do it. Toss the high score, toss the low score, keep the mid score, okay?
And part of the reason that they do that, it's because, for example, if I work for a AT&T, and AT&T is only reporting your credit to Experian, is not reporting to TransUnion and Equifax, then that means that you will probably have a positive credit score. If you're positive credit on AT&T, then you will probably have a positive credit score with Experian than what you did with TransUnion and Equifax. So that's the reason why lenders usually use the middle credit score, not the average, just the middle one, because that is actually taking into consideration any different agencies that actually report to just a single credit bureau.
Hey, Porfirio and Aretha.
Yes.
We have a comment, and I thought it might be worth expanding on this. Will you all talk about the way that we help clients review their credit?
Yes, so the way that we help our clients review their credit, we basically pull a tri-merge credit report from Credco, which is typically one of the agencies that lenders uses. What we do is we analyze the credit and make sure that clients don't have any negative history with their last 3 years. Typically, why 3 years? We'll explain that in a bit. Why we do the last 3 years.
Now you have some things that we look at that's further than 3 years that lenders are going to look at. And those things are kind of like if you have a broken lease or something of that nature, those are things that we have to talk about, okay?
There we go.
Okay, what makes up a credit score? You have different factors that make up your credit score. Your payment history, which is 35% of your score. So it's the biggest part. Very, very important. You have, after that comes current debt, the total of debt, the amount of debt you owe, 30%. Your length of credit history is next at 15%. How long you've actually had credit or used credit. Types of credit, 10%. And then any kind of new credit is also 10%.
Now, right here, what I would like to talk about is, you see how we talked about why we used it within the last 3 years? Because if you see here, the 35%, it's what makes up your credit score is your payment history. So any recent bad credit or good credit, it's going to affect your credit score more than an old account, okay? So for example, if you have a collection account within, like, let's say, for instance, 5 years ago, and then you have one that is recent from like last year, then the one that is going to affect the most on your credit score is going to be the most recent one than the old account, okay? Because it's 35% of the history, okay? Now, right now, there's the question says, why does credit score drop after paying off something off? So typically that happens because you're losing that credit. Now, it would tend to drop initially, but then what will happen is that later on, you will be able to increase it after that. Okay, so it will drop once you pay something off, but then it will increase again, okay?
Okay, the biggest factor, which is the payment history. Okay, lenders want to know, will I get this money back? Okay. And they're looking at, have you paid your bills on time? Have you made any late payments? If so, how late? Was it 30 days? Was it 60 days? Was it 90 days? Okay, how recent was it? They're looking at to see if you have any accounts in collections, if you have any judgments, any liens, things of that nature. But paying, like I said, you need to pay all your bills on time. Paying bills late by 30 days or more, it can dent your score and, you know, just make it hard, just cause a lot of damage. But the ways that you can keep that from happening is kind of like, you can set up auto pay. You can do calendar reminders so you don't miss due dates. You might also want to ask creditors to move the due dates to better align with when you get paid, you know, so you don't have any problems with making payments on time. Because again, that's a big factor. If you pay anything late, 35% of your credit score is based on that. So I tell all my clients, please, please, please be sure to pay your bills on time. If you haven't, if for some reason you can't, reach out to those creditors, let them know something came up. I'm not going to be able to do it at the time that is required, but can you work with me? Can you push it back maybe a week? Can you push it back 2 weeks? Whatever you need. Communication is key. All right, you got to reach out to these creditors. And I know a lot of times we don't want to, but we have to in order to make sure our finances are where they need to be. Go ahead, Porfirio.
No, go ahead and finish.
Yeah, I just don't want you to think because you've let this happen that, you know, you can't take care of it. You can take care of it, okay? Just because you made a mistake one time doesn't mean that you can't fix it, okay? Everything is fixable, all right?
One thing that I wanted to explain to you on this right here is, what are the difference between a charged off, a bankruptcy, a judgment, and a foreclosure? Okay, so charged off, it means that your lender, wherever you took that credit from, is charging off that bill, meaning that they have removed it from their books because they have probably attempted to collect it from you for a couple of years. And what they did was like, okay, we're probably not getting this money right from this person. So what they do, they remove it from their books by doing a charged off. Now that does not mean that you don't owe that credit anymore. So a lot of times what that happens is that they tend to sell that credit to a collection agency. So let's say, for instance, it's with Sprint, and if Sprint's charged it off, but then later on, they can sell that credit to ABC collection agency. And that's when it starts hitting your credit score again, okay? So just because you have a charged off account, that doesn't mean that you don't owe that anymore, Okay, that means that the lender or the creditor is not actively seeking the money, but that does not mean that you don't owe it. Okay, now the bankruptcy, and adjustment and foreclosures, those tend to hit your credit score and it will drop dramatically. Okay, because whenever those three things are in, that means that it's a big loan that you took out. Okay, for example, bankruptcy with the house, same thing with the foreclosure, or if you declare bankruptcy, you probably declare with all your debt. There's probably a big lump sum of money that you're put in bankruptcy, so that will dramatically hurt your credit score.
Bankruptcies and judgments and foreclosures, those are not, I don't want you all to think that those are things just detrimental that you can't come back from. You can. Life happens to everybody. No one knows anyone's particular situation, why they had to do a certain thing. You can bounce back from that stuff. But before you do any of it, you need to make sure you're seeking legal advice, okay? Or like I said, or either a credit counselor. Don't just go do it because you're stressed out and things like that. We know a lot of stuff is going on right now, so if anybody's considering that, by all means, research and get legal counsel before just going and just doing it. Last thing, paying bills on time is the most positive impact on your credit score, okay? Late payments, accounts in collection, and charge-offs are all negatives. Okay, let's talk about your current debt. Lenders are asking, what's your capacity, okay? They want to know about your credit utilization. How much credit are you using, okay? High balances, those things. If you have a credit card limit of $2,000 and you already have a balance of $1,500, that means that you're using a lot of credit, and that can look negatively. A lender can view that negatively, okay? So you don't want to do that. You want to try to keep your balances under 30%. Excellent rating would be keeping your balances under 15% of your loan amount, okay? Lenders are weighed heavily on the balances owed versus the original loan amount. So again, these kind of things you want to keep at a minimum. Keep your balances to no more than 15 to 30%. Now, to keep credit utilization low, you can try things like setting balance alerts, or making extra payments to get those on down. But the very good news is that the damage can be reversed. If you have high balances, it can be reversed. Once you pay down a high balance and the creditor reports it to the bureaus, the damage disappears, okay? So no problem. Everything can be fixed, okay? And let's talk about debt to income ratio. What is this and why does it matter? You're gonna hear this all the time going through this process, debt to income ratio. And what you're gonna hear the lenders say, they call it for short, it's DTI. So I want you all to remember that, DTI. Anytime they say that, we're talking about debt to income ratio. Your DTI shows how your debt stacks up against your income. Lenders use DTI along with credit history to evaluate whether you can repay a loan, okay? And they are very strict on this. Different lenders have different ratios that they use, so it's all on the lenders. And then different loans have different ratios. Say a conventional loan. A conventional loan, the ratios are 28/36. So basically what it's saying, they don't want the top number represents the housing. That bottom number represents the debt, okay? So on a conventional loan, they don't want your total housing payment to exceed 28% of your income. And they don't want your total debt, including your housing payment, to exceed 36% of your income. And then you have like the FHA loan. Their ratios are 31/43. They give you a little bit more wiggle room. The top ratio representing housing payment. How much of your income can go toward housing? 31% on an FHA loan. How much of your debt can go toward how much of your income go toward debt with FHA loan is 43%. Okay, so again, they're giving you a little more room. Okay, but on average, you don't want your debt to exceed 40%. Okay, those are actually Dallas Habitat's ratios. Our ratios are, if you purchase a home with us, they're 30/40. Okay, meaning that your housing payment should not exceed 30% of your income, and your debt, which includes the housing payment, should not exceed 40%. So when we're counseling you, because each situation is different, when we're counseling you and we're running the numbers, we're gonna let you know what your ratio is, okay? And if it's close to that 40%, we're gonna have to get it down, because we don't want you to go into any kind of housing and be strapped, fist to cuffs. That's not our goal. Our goal is not just to put you in a house and say, hey, just deal with it. We want to make sure you can get in that house and stay in that house, okay? So that's why we're going to be weighing those debt to income ratios heavily. Okay, Porfirio?
Yeah, and when we speak about debt, it's anything that it's on your credit and that you're paying on a monthly basis. Okay, so that's like your car notes, that's your credit cards, that's your student loans if you're paying them on a monthly basis. That's your personal loan. So anything that you are paying on a monthly basis, the minimum payment, that's part of your debt. Okay, so it does not include like your rent. It does not include your utilities. All those are expenses. So like Arita was explaining to you, it's that 40%. It's that we're looking at as a ratio. Now that's 60%, because 40 plus 60, that's 100. So that 60%, it will be all the other expenses that is not on credit.
Okay, and before we turn off this slide, Porfirio, or just let me mention, I want to be able to give you all the numbers, how you can calculate your DTI, okay? You just take all the recurring monthly payments, including housing, and then divide the total number by the amount of your gross monthly income, okay? And this is gonna be your DTI, your ratio, okay? So for an example, your monthly debts total $2,000. You take that $2,000 and divide it by your gross monthly income. And we're gonna say our gross monthly income is $5,000. My ratio would be 40%, okay? 2,000 divided by 5,000 gives me 40. So my ratio will be 40%. That means I need to try to pay some of that $2,000 debt down and get it under 40%. Everybody get that? You take your recurring monthly payments, including housing, and then divide total number by the amount of your gross monthly income. And this will be your DTI, okay? All right, thank you, Porfirio. Length of history, this is very important too. Lenders are asking, can you show long-term credit history, credit use? How old is your oldest account on your credit report? A longer credit history just provides more information, and it offers a better picture of long-term financial behavior. And don't worry, just because you may not have a long history, it does not mean you can't get a good credit score, okay? We just want you to know that if you have a long history of credit and it's good, don't try to close things out. Like if you have a credit card that you've had for years, leave it open. If it has a zero balance, leave it open. That's good, especially if you're maintaining it and keeping up on the payments, because that looks good to a lender. It shows that, it helps you maintain that credit history that's associated with that account, which gives you that length of history that the lenders are looking for, okay? Types of credit. Lenders want to see, can you manage different types of credit, okay? Repaying on different credit account indicates that borrowers can handle all sorts of credit. They want to see that you have automobile loans, that you can handle credit cards, student loans, mortgage payments, different credit, okay? But while you're going through this process, I don't want you to open any new credit, okay? Not unless your counselor specifically says, okay, we need you to look into obtaining some kind of credit, okay? We will look at
so right now, what you're
Go ahead.
Right now, while you're going through the the homeownership buying process, or whatever you're entering right now in the home buying process, that's the way that you should stay right now until you speak to a counselor. So right now, just because you hear Aretha say that that lenders want to see that you have credit cards, auto loans, and student loans, and a mortgage, so you're like, okay, well, right now I'm already getting trying to get a mortgage. How about tomorrow I try to get auto loan? Let's not do that right now because it might not be the best option for you. Because remember, we have to take into consideration your debt, okay?
Okay, new credit. New credit is 10% of the score. Lenders are asking, what's your cash flow like? Okay. If you go and you open up a lot of credit, you apply for a lot of credit, that may show to a lender that you're in some kind of financial trouble if you're applying for a lot of credit cards. Okay, so that doesn't look good. So again, no new credit unless your counselor specifically says, hey, we need you to look into, obtaining a secured credit card or something like that. And applying for new credit means lenders will do a hard pull. A hard pull is gonna result in a decrease in your score. Okay. Anytime they do an inquiry or anything on your credit, 9 times out of 10, it's going to result in a decrease in score because they're doing a hard pull. And again, too much, if you're applying for credit cards, every credit card under the sun, anytime you get an offer, you're applying for it. That may indicate to a lender that you have a need for cash, and that doesn't look good. Okay.
All right, so we're going to go ahead and run a second poll to see, based on what we have discussed previously, if you can answer this true or false questions regarding credit. All right, so the first question says, does medical debt does not affect your credit score? True or false? Okay, having no credit is good. It's a good thing. True or false? And then also, student loans in deferment are not taken into consideration when qualifying for a mortgage. True or false? And this is past due child support can affect your credit score. True or false? We're gonna go ahead and give you a few minutes to answer those 4 questions for us. And again, those questions are going to be anonymous, so I'm not going to be grading you if you're in my account, if you're my client. But I do hope you get it right, though. All right, the answers are in. So, so it says the medical debt does not affect your credit score. The answer, majority of y'all said false, and that is correct, because medical does affect your credit score, okay? It does, especially if it's current, okay? And then the next one, it says having no credit is a good thing, true or false? False, again, because remember we said that lenders want to see that you have credit. Now, later on, we'll discuss another ways. If you don't have credit right now, we'll discuss other ways that you can prove that. Then the third one says student loan in deferment does not take into consideration. Now, this was, the majority of y'all said it was false, and that is correct. So student loans that are in deferment aren't taken in consideration when applying for a credit card. Now, they are taken in consideration because that is a debt that you owe, okay? And then past due child support can affect your credit score. And that majority of y'all said true. And that is correct, okay? Because the child support is a debt that you owe, okay? So it will affect your credit score. And we'll go ahead and close those poll answers.
Porfirio, let me ask you a couple of questions related to some questions that we've received in the chat related to these poll questions. And can we dig in just a second about how student loans are calculated by lenders when they are in deferment?
Yes. So, so what lenders typically do, it all depends on the lender that you go with, okay? But the majority of the lenders, if your student loan is in deferment and you do not have a minimum balance that you're paying right now because you're in deferment, what they would do is that they would take 0.5% of the balance that you owe and add it to your debt to income ratio. Okay, why do they do that? They do that because they know that at one point you will have to pay this loan back, and they don't want you to have the house and be unaffordable if you're still paying this loan. Okay, so that's what they do, that they add 0.5%, so 0.005 to your to the balance that you owe of your student loans.
And also with the student loans, even if some people say, well, my loans are going to be they're going to be forgivable because of the occupation that I'm in. They can't forgive them until you have that letter saying that has went through. Okay, so until you have that letter, they're going to include it into your debt.
One more quick question before we stop sharing this poll and move on. We've gotten a couple of questions from the audience about medical debt and the impact of medical debt on your ability to qualify for a mortgage. Can you guys speak to that briefly?
Medical debt, like I said, it affects your credit score. So say you go to the doctor, you went to the doctor 2 months ago and your insurance paid their part and you got a bill in the mail, but you didn't pay that part. They have up to 180 days before they can put that on your credit report. Now they're gonna keep sending you letters, calling you saying, hey, you have this bill due. So if you just ignore that, they will put that on your credit report. And guess what? That's gonna affect your credit score negatively. So we're trying to get your credit score up. And that medical debt is hurting it because it's bringing it down. Now, if you have a lot of student loan debt, say maybe $10,000, over $10,000, then a lender, if it's not affecting your score, it said it was a while back or something and it happened and you have a pretty good credit score right now, a lender's, that's not gonna hurt you so bad because a lender will probably want a letter of explanation from you saying, okay, why do you have so much medical debt? And you can just say whatever it was. 2007, I was in a car accident and I accumulated a lot of medical debt. Bam, letter of explanation. They're good, okay?
Right. Yes, so it does. So medical debt does affect your credit score. Now, some lenders, like Arita was explaining, they could use like a letter of explanation depending on the amount and how old that medical debt that you owe is. Okay, so yes, but it does affect your credit score. All right, so let's move on to the importance of credit. So now, why is credit important, you might ask, okay? So the interest rates, right now where you're going through the mortgage process, whenever you have a good credit history or credit score, that means that you have a better interest rates on auto loans, student loans, or just personal loans. You also, some lenders also do a credit report or pull your credit if you're looking for employment, okay? And the reason that they do that is because they want to know that are you able to track your finances well, so that you can track their finances of the company in consideration as well. All right, a lot of y'all know that if y'all are leasing an apartment or maybe furniture or anything like that, they will also pull your credit. Why? Because they want to see that you have not owed an apartment complex, that you were not passed through an apartment complex, or maybe a furniture place that you taken out furniture from that you did not owe that or have a collection account in it. So they will use that credit. Okay, establishing utilities. Okay, so a lot of times whenever you are calling, they will pull your credit report, and basically what they want to know is like, do you owe an electricity bill from a few years ago, and now you're trying to establish to a new electricity bill. Okay, so ultimately a lot of that will indicate if you pay a deposit for that service. And then also the insurance rates. Okay, so why interest rates? So because it is, there has been studies that shows that people that have a lower credit score tend to submit insurance claims more often. Okay, so having a good credit history will determine what interest rate you have. So if you have a lower credit score, that means you probably have a higher deductible. Okay, so where do you order your credit report? Okay, so go to www.annualcreditreport.com. Okay. This is because the Fair Credit Reporting Act provisions that was enacted in 1970 that says that you are entitled to know what's on your credit. Okay. So because of that, you are able to order a credit report from all three credit bureau agencies. Okay. Now it does not include your credit score. Okay. What you will get is just basically all information, all your credit history. Okay. But it will not include your credit score. Okay. Now, because of the COVID-19, there has been updates that you can order your credit report from each credit entity, from Experian, Equifax, TransUnion, once a week up until April 2021. Okay, so take advantage of that. Okay, if after April 21, after April 2021, then you can order that once a year. So what I typically recommend to clients is that if you are ordering from, let's say for instance, Equifax first, then 3 months later you can order from Experian. Okay, and then 3 months later you can order from TransUnion. Okay, that way you know exactly what's on all your accounts.
Now you all, nobody has any excuse not to know what's already in your credit report, because just like he said, due to COVID-19, you can go to www.annualcreditreport.com, pull, every week you can pull a credit report for Experian, TransUnion, and Equifax, okay? And you can know what's on there, and if you are, everybody already knows their situation. So if you want to get ahead of the game, start working on that. Start paying off stuff.
All right, so what are the types of credit? Okay, so there are different types of credit and the use and responsibility. For example, an individual credit, whenever you see your credit, that means that if it's individual, that means that only one person owes that debt, okay? Now, if it's a joint, that means that more than one person owes that debt, all right? Now, if you're an authorized user to a credit, that means that that individual that took out that credit is the one that owes the debt, and the authorized user does not have any liability on that debt. Now, what that typically happens is that it's to help clients increase their credit score. Now, you would only take advantage if that person that owes a debt has a positive credit history. For example, if I add you to my credit account and I've late every month, then as an authorized user, you will have bad credit history too, because I have the bad credit history. So you're taking advantage of that too. Okay, or the disadvantage of that too. So as an authorized user, you do not owe the debt. You are only taking you don't owe the responsibility. You're only taking what the benefits of it, or the disadvantages. Now, payment arrangements, they are installments. So basically that means that you are making payments on a monthly basis. Revolving accounts, that is, if you use it, then you owe it. Okay, such like credit card. And then you also have those accounts that are open 30 days. Okay, so maybe it's a personal loan that you have. It's open for 30 days. Now, what does co-signing for credit mean? Okay, a lot of y'all were thinking about like, okay, so what if I co-sign for a car note or co-sign for a mortgage? Now, co-signing, it's just like a joint account. Okay, it means that you are liable for that debt. Meaning that if I don't pay for that debt right now, because I'm the one that pulled that credit, then you will be responsible for paying that debt if I don't pay it, okay? So co-signing, it's not a great thing, okay? I don't care if it's your mama, your papa, your sister, your brother, your auntie, anyone, do not co-sign, okay?
And we totally get that. We understand, you know, family wants to help family, but when it comes down to you and your family trying to pursue home ownership, you got to tell them, hey, this is our goal. This is what we're trying to do. And we just don't think it's a good idea. Because what co-signing can do to your credit, say for instance, if the borrower is late on a payment or they skip one entirely, it's going to show up as a negative mark on your credit report. And even if the borrower is in good standing, say they're making payments on time, you can still run into problems. Any loan that you co-sign for is going to show up on your credit report as one of your debts. And that means if you apply for a big loan for yourself, such as a mortgage, you may get turned down because it looks like you already have too much debt because you've co-signed for somebody else. okay? So just not a good idea.
So non-traditional alternative to credit. So a lot of y'all might say, well, right now I don't have anything on credit. So what do I need to do? Okay. So some lenders can take in consideration alternative credit. Okay. Such as like option may include like rent payments. Okay. So if you have had rental history for more than 12 months consecutively that you have paid on time, they can use that as a alternative trade line. That means that what they would do that they will add that rental payment to your credit so you can get some kind of credit score for them. Other items include like utility payments, okay? So the utility payments is any accounts that are under your name. And like, again, like I said, it has to be paid consecutively for at least 12 months. Child care or child support, okay? If you can prove that you pay child care or child support for 12 months, it's another way that you can have sufficient trade lines. Even a gym membership, you have Netflix subscriptions or cable subscriptions, all that can take in consideration as an alternative trade line. Okay.
With alternative credit, they just want to know that they just want to see that you've been making payments on time for at least 12 months in order to use that alternative credit, okay? And everything has to be documented because they're going to need proof that you've been doing this, okay?
Now, what are ways that you can establish credits? Okay. Now, you want to pay your bills on time. Okay. I know that a lot of times it's kind of hard, but remember, we always say this: pay yourself first. And this is what you mean. What we mean when we say that we pay your bills on time first. Okay. Open a checking or savings account. Okay. Apply for loan using a savings as collateral. Also apply for secured credit cards. So secured credit cards are those cards that you are basically putting your money in there to establish credit. Okay, not all banks or credit entities offer a secured credit card. So you will have to do your research, but that is the best way for you to establish credit if you don't have one. Again, don't do it if you have not talked to a counselor on it. Important on this is that do not open new credit accounts during your mortgage application. Again, especially if you're working with a counselor or if you're already working with a lender, your lender will tell you exactly what to do as well. Anything you want to add on this, Aretha?
No, I just want to stress, just like you said, if you're waiting to have a session with Porfirio or myself, please, please, please do not open any new credit accounts until we review the file with you, okay? We're going to have a discussion around that. That's very important.
Now, tips for improving your credit score. Okay, so you want to correct inaccurate information. So let's say, for instance, you got your credit report from Experian, Equifax, and all those credit bureaus. You see that there's inaccurate information that does not belong to you. You want to automatically contact them and see what that is about, so they can go ahead and remove it. Okay, consistently pay your bills on time. Keep your overall debt at a reasonable amount relative to your income. Again, we say that no more than 30%, no more than 40% of your debt, of your income should be towards debt. Only open new accounts only as needed. Again, we cannot stress this enough until we get tired. But if you're working with a counselor or a lender, they will tell you exactly what you need to do. And manage your credit accounts responsibly. Okay, so just because you have a credit card right now, that doesn't mean that you can go out shopping and put it to the maximum limit. Okay, you want to manage it responsibly. So think about it. Think about it this way: if I have a $1,000 credit limit on my credit card, then I could go and spend $1,000, but we don't want to, because what that would do is that it would say that you are in need of money. It means that you are in need of cash. So what you want to do is that just buy what you are able to pay tomorrow. Okay, and what I mean is like, when I say tomorrow, if you're able to pay tomorrow, yes. But what I mean about that is like on your due date. Okay, so if I'm going to be able to pay at the billing cycle, at the end of the billing cycle, I'm able to pay 150, then go ahead and buy 150 so you can pay it in full amount. Okay. If I'm only able to pay $10, then only spend $10 on that credit card. Never go over 30% of your credit utilization on your credit card. Again, like I mentioned, that will say that you are in need of cash. Okay. Oh, we're done. Any questions?
We do have some questions.
Oh, wow.
Our first question is, if I am approved for a mortgage, so I have a loan approval from a mortgage company, it could be Dallas Habitat's mortgage company, it could be a traditional lender. Am I in the clear since I'm approved to get new credit?
No, you're not on the clear to get new credit because you still don't close on that mortgage loan. Okay, so we typically recommend that do not get anything until you actually close. The day after you close on your mortgage or any loan, that's when you want to get new furniture on credit on all that. But before you close, you don't want to do any changes. You're not clear.
No changes to your paperwork, no changes to your finances, no changes to your job. If you can do it, okay? No changes whatsoever.
Really important point. You know, at Habitat, we get this question quite a bit, right? From our home buyers who are coming through our program who get to, 2 weeks before closing and say, well, Porfirio, Aretha, I'd like to get some new furniture for my house. And we get that, but the thing is, unless you're paying cash and you're paying cash that's not coming out of money that you have saved for your down payment, saved for your closing costs, best to wait. Best to wait. And all of us who have been first-time home buyers can absolutely relate to this. We have a comment saying, seriously, no new credit, not even furniture? Seriously. Here's the thing. Your credit is a very fine balance, right? When it comes to your credit score, your debt to income percentage, like Porfirio and Aretha have mentioned today. So even the most minor of changes, you'd be surprised. Even if you're just borrowing, $500 for furniture, that can absolutely swing your ratios and your score out of whack at the nth hour and keep you from closing on the loan. So the best rule of thumb, generally speaking, is do not touch credit. If you have been approved, wait until you sign on that dotted line at closing, and then get whatever you want on credit. Make sure you pay your bills on time.
For whoever asked that, do like I did. You roll around on that new carpet until you close on that loan. I just put out an old mattress until I can get that, till I close on that loan.
We have all been there. Our next question is regarding medical debt or like outstanding utility bills. The question is it better to pay off those bills in full, or is it better to get on a payment plan if you have a past due cable bill or a past due medical bill?
I would say it depends on how old it is, if it's something, you can negotiate, and maybe, like I said, if it's something small, say you have something on there that's maybe $100 or $200 and it's been on there for a couple of years or something, and you want to take care of that, go ahead and negotiate with the creditor, because at that point, they're probably willing to negotiate and you don't have to pay a whole lot. But if it's something that's huge, it has a larger balance, you might just want to get on a payment plan with them, okay? Make out some kind of payment plan. But anything that you do, you make sure you get it in writing first before you send them any kind of money, okay? Everything needs to be in writing when it comes down to dealing with creditors, okay? Because you can get that, you can have that debt, pay it off, then they'll come back and say, oh, no, we don't have no records of that. You keep your own records. Make sure you get everything in writing, keep your receipts to show that you paid that debt off.
That's a really good pro tip too, because if you are working with a mortgage lender and you're disputing an item that's on your credit and you can show that paper trail, that can work in your favor sometimes, depending on the nature of the credit issue. Our next question is, our participant says, we know you said no changes to your job, but I have to ask, what if it's a new position or promotion within the same company?
Oh, that's great. Yeah,
Right.
we're not going to limit you on, we're not going to do anything that's going to jeopardize your family. The more money you make, the better, especially when you're purchasing a home. So if you have a promotion or something coming up, great. And we don't want you, and you shouldn't change a job, but we know sometimes it happens, but you just need to keep your counselor in the loop, okay? Let us know what's going on. Communication is definitely the key when dealing with your counselor. We need to know this is a personal thing. We're working together. I need to know all the ins and outs, what's going on. If you're thinking about switching a job or something, we're not saying that it can't be done. We just don't want you to do it right now, okay? Because it can cause a hindrance in your process if not done the correct way.
And what lenders mean about not changing employment, they basically mean that don't change employment from being someone working at an office as an office staff and then working out for Amazon, like two different industries. So that's what they don't want, where you have a change of industry or, of whatever you do.
Another thing with that, if you're hourly and you go to commission, that can influence your loan big time and cause you not to be, pre-qualified anymore. So definitely, like I said, anytime you're going from, again, hourly to a commission type pay, then that's gonna, we need to weigh heavily on that because that's gonna affect you.
Really good points. We have a couple of more questions for anybody that can stick around for just a couple more minutes on the line. We'd love to have you. We want to make sure we answer your questions tonight. We have a question from a participant that says, what about a student loan that your daughter had while she was in college and it appears on your credit because she used your information? Really good question. Who wants to tackle that one?
Meaning she didn't give her permission?
Unclear. She could have given her permission, or perhaps not. And this is an anonymous attendee, so if you want to elaborate on that, whoever submitted that, you're welcome to do so, but don't feel like you have to.
I mean, if it's showing up on your credit report, that means that it's yours. Either the way it looks to a lender is like you co-signed for that loan, so you're gonna have to resolve it some kind of way. Whether it's with your daughter, with the creditor, somehow or another, you're gonna have to resolve that. If it's affecting, you getting pre-approved for a loan.
Yeah, and in fairness, the participant didn't say that it was past due or anything like that. So if it's not, just know if it's still an open balance, to our point earlier, it may be taken into consideration with your debt to income ratio in that regard. But if it's not past due, and if you gave permission for that, just know it'll be taken into account in that way. Okay, our next question related to tonight's subject is, once a payment is made to a collection agency, how long does it take to get removed from your credit report? Or can I call the company and ask for it to be removed since I had paid it in full?
So it usually takes about 30 to 60 days for a actual item to be removed from the actual credit bureau. So keep in mind that you're paying the entity where you owe the credit. You're not paying the credit bureau. So the entity that you're paying the credit has to report that information to the credit bureau. And now the credit bureaus have to update their system. Well, they don't do it automatically. Well, they do it automatically, but they have to update it every 30 to 60 days. So if for some reason you received the letter that says that you paid it in full and that you don't owe any debt anymore, and after 90 days, it's still showing on your credit report, that's when you want to contact the credit bureau and let them know, we already have this paid off letter and here's proof. So you go ahead and remove it from our credit report.
And also that letter helps too, so it doesn't hold up your process. Because if we have a letter from your creditor saying that your debt was settled or paid as agreed, and it showed an account number with your name and everything on that, we can move forward. We don't have to wait. We already have the documentation that shows that this was taken care of.
Great points, great points. We have a question about, let's see, a broken lease. That's a great question. If a broken lease on an apartment is over 7 years old, will it still show up on my credit?
Depending on how that lease is, if it's a judgment, it will appear on your credit report, and it will stay there until you pay that judgment or that lease. Now, if it's a past due balance, it could be a charged off. That means that you still owe that balance, like I explained to you earlier. But if it's just a item that you have just not paid, it's still in collections and all that, then it will not be removed. A lot of people think that have that misconception that something negative in your credit will be removed after 7 years, and that's false. Okay, because again, that entity that you owe that lease can sell that to a collection agency, and those 7 years start all over. Okay, so that is a misconception that people have, that bad credit will be removed from your credit after 7 years.
Yeah, and that happens every day. It's not fair, but it does happen. They sell the debt, and it's just like it was new. It's fresh. Okay.
We have some similar questions coming through that I'm answering live for y'all that ask these questions. We have another question about how much on average do credit scores increase after you pay off a collection account?
You really don't know, because they don't give you a guideline to say how much your score is going to increase. It's just something that we keep an eye on. Anytime Porfirio or myself, we pull your credit report, it's a soft pull. So we can pull your credit report every 30 days and it's not going to affect your credit score, okay? So if there's something where you paid off something and we're trying to increase your score, we're probably going to pull it every 30 days because we want to see what's happening with that score. Is it increasing, okay? Are we heading in the right direction? But generally speaking, you know, there's just no easy way to tell how many points that is going to increase.
Remember, it's so easy to bring your credit score down because of bad credit or a bad habit, but it's so much difficult to bring a credit score up. So any positive impact on your credit will increase your credit score, but it would take some time.
Okay, good questions. Our last question for the evening is, I recently settled an account, but it wasn't removed from my credit. It just shows a zero balance. Are we saying tonight that she may still be able to get this removed from her credit?
If you all, when you made that agreement with your creditor, if you didn't agree for them to remove it, then they probably won't. You can go back to them and ask, and it's strictly up to them if they will, because you don't have anything in writing saying that they were going to do that, okay? But if you do have something in writing, by all means, reach out to them, provide them with that information, and let them know that it needs to be removed.
Fantastic. Porfirio, Aretha, we want to thank you both so much for imparting all of your knowledge, debunking our credit myths that we had tonight. To all of our participants that are still with us, we want to thank you for taking time out of your evening to join us on this incredibly important topic and relevant topic. If you're working with us in our program, we're so excited that you had the chance to meet our counseling team tonight. Just know every time that you reach out to us, you call us, you email us, it's one of the three faces that you see here tonight who's going to be responding to you. This is our team, but we're small but very mighty. And we are so pleased to have the opportunity to work with everybody who's here tonight. Be sure to check out our future webinars on our webinar calendar that's on our website, www.dallasareahabitat.org, under the education section. And again, as a reminder, you can go back and watch our previous webinars on that same calendar on demand. So we hope to see you guys again soon. We hope you have a great night. Thanks so much.
Thank you, guys.
Thank you all. This is all new to us, and we're learning as we go, you know, as far as how to do these webinars and, you know, how to get on here and get you all the information that you need. So we appreciate you all sticking with us and just coming to learn the information. Thank you so much.
You have a great evening, okay?
Have a good evening. Bye-bye.
Get some wine.
Bye-bye.
Get some wine now.